What is up, y'all? I know it looks different. In fact, I've talked about making these videos better, to be more informational, easier to watch, and more entertaining too. I hope this looks better, okay? Uh, don't mind the shit on the screen. It's just for fun, bro. I love Five Nights at Freddy's. But whatever. Enough yapping. Let's get into this video and speak about something very important that everybody needs to know in order to become profitable. And this is still simple on the side of what you guys might not be used to yet. So, what we're going to talk about, and we are going to go in depth with this time frames. Now, I know I've talked about time frames in the past. You guys have added the 1 minute all the way up to these hourlies and the seconds, maybe some of you. But like we were talking about in the last video, time frames, you guys don't truly know how important these things are, okay? You do know one thing: every single confluence I talk about, if you have been paying attention, works on every single time frame. Holy shit, bro, I feel so much more professional. I'm looking at a camera right now. I'm looking at an actual camera. A Nikon Z30. I think I spent like $800 on this. Okay, whatever. We've talked about how these confluences work on every time frame, but you can't really just have every time frame because there could be a million time frames, okay? Technically, you could have the 5 minute and 1 second, the 5 minute and 5 second. You can have any interval, okay, of time. The goal is to have the important intervals of time. And the ones that could, be fillers, make sense. Okay? You need things to make sense. Now, especially with trading, right? Things are not just the way they look, things are the way they actually work. Okay? And to make something work, it needs to make sense. So let's make sense of time frames today, guys, okay? So get your charts out, okay? And I want you guys to first off see the difference on your chart. You guys have to start doing this. Just switch tabs. It's very simple. Look at the 1 minute time frame, okay? And then move to S&P and look at the 4-hour time frame. And if you guys have added those indicators, which you should, you'll move to the New York City AM from yesterday, which is for me Friday. If you guys have not added this indicator, you're going to search up this indicator like I told you to do already, because this is important. Basically, you're going to search up that indicator, okay? Right in this tab. You're going to search up ICT kill zones plus pivots, TFO by trade for op. Make sure it's by trade for op. Also, make sure you see the number of downloads is going to be high. That's how you know it's going to be the one. So, instead of the 4-hour on S&P, go to the 1 hour. Okay? And you'll see these indicators too. The current indicator, fuck. It is a little bit off for me. If this is off for you guys, sometimes it's about 30 minutes off just for the New York Open session. The indicator is off just a little bit. It's very annoying. So instead of this being here, it's really supposed to be here. It should be at the start of the 8 a.m. candle, not 9 a.m. That'd mean it's starting at 10 a.m. That's weird. Okay, cool. So now that you have the 1 hour time frame open on S&P and on NASDAQ, the 1 minute, I want you guys to kind of look, right? I want you guys to look in this area on the 1 minute and look in this area on the 1 hour. And obviously, before you look, your chart does not have to look the same. Just do the last market open area on each chart that you guys can see, okay? And when you look at this area, you're going to notice, right? The candles are different, right? They might look worse overall. I mean, if you look at this whole trend, right? What looks better? What's cleaner? Obviously, the 1 hour. That's because in a single higher time frame candle, you have multiple smaller time frame candles inside, right? And when you have 15, let's say you have 15, 5, 20 random 1 minute candles that are bad quality. What's the 5 minute time frame going to look like? It's going to look better, right? Let's say you have 35 minute candles in one candle, and these 5 minute candles look good. How good is the price on the 1 hour going to look? Extraordinarily good. It's going to be quality, top notch tier price. So as you can see, if we go to the 5 minute on NASDAQ, okay, and we scroll to this area, obviously the box that we have marked out. You don't have to mark this out, by the way. It should be marked out for you already with that green background. And also you can customize, you know, lower the opacity. I know the opacity starts at like in 90% or something crazy. And when you look at, you know, the 5 minute on NASDAQ and the 1 hour on S&P, you'll notice that we have some good candles here, but the rest of these candles suck. But then the rest of these candles on the 1 hour look good. That's because we've combined price. Okay? So this is why I say higher time frames are stronger. For example, guys, right? If a 1 hour point is closed above, okay? Holy fuck. If a 1 hour point is closed above, how important is this candle? Fuck, man. Sorry, guys. This video is not off to a good start. Some shit scared me behind me. Oh my gosh. Yeah, so if this candle that closed over this 1 hour point is bullish, right? Green. What does this mean for us? Do you think we should like necessarily go short right away, or should we maybe wait for more confirmation that it's going to go short and not just go up, for the reason being that the 1 hour candle just closed above? So I know that's hard to understand, but what I'm saying is higher time frame candles are more powerful than the lower time frame candles. So our job is to see when these candles close, how they close, how the price moves on specific time frames by using lower time frames and higher time frames. Now, the reason why we have to have the right time frames is so we don't confuse ourselves with market analysis paralysis. Do you know what I mean? If you have 1,000 time frames, obviously you can't look at every single one and then place a trade on time. You're going to be late. The trade's going to have happened before you could even fucking place. This is why we have important time frames. So again, if you haven't done this, I want you to do this. You have to favorite, so it's in your hotbox, the 4 hour, the 1 hour, the 45, the 30, 15, 10. Obviously, all of these. And if you have the seconds, do the seconds too. 1, 15, 30. Now, why do I not have days? Because days are so powerful. And since I'm trading on the 1 minute or 3 minute or 30 second, if a day candle closes, guys, do you think if a very powerful candle, far more powerful than the 1 hour and 4 hour, if a daily candle closes to the upside, do you think we're going to go up right away? No, it's going to take like 5 hours to make that decision. And I'm trading on the 1 minute. I'm trying to make very low time frame decisions, so I want time frames that will relate to my 1 minute, 30 second, and 3 minute. That makes sense. It's like if the yearly candle closed above, would the market just instantly start going up, or would the market freaking, take its time for the next couple weeks to then go up, right? Think of it like that. So you don't need these. And again, these filler out, some of these time frames you could just say are fillers. You don't need the 2 and 3. The 1 and 4 for the hourly, since they're so high time frame, that's enough. Sometimes if the 1 hour is bad, I'll look on the 45-30 for something like a fair value gap. I'll get into that in the future. So that's, you could say that's a backup. But the fillers, the true fillers that I have are the 10-minute, 7 and 6, and then 3 and 2. Because the 1 minute, the 5 minute, and the 15 are the important low time frames, the very important ones. But if those time frames aren't showing enough, if you quickly switch to the 10 to see if something happened, if you quickly switch to the 7, the 6, and the 3 and the 2 to see what's happening, you can formulate more of a understanding of where market might be going. Sometimes this is just how it is, right? Trading is not always how it looks. Trading is sometimes something specific happening that you are like, okay, if the 2 minute just closed over this fair value gap and has clear proof of a retrace coming into a 2 minute, but the 3 minute just has no fair value gaps, and then you switch to the 7, and then you're like, oh, we also inversed on the 7 to the upside, I might want to go to the 30 or the 1 to place a freaking long. Okay, sometimes you can't rely on just a 1-5 to be your savior. Okay, so that, I hope that makes sense. Okay, and now that you have these marked out, you understand how these things work, why we use them, and also why they work differently. Let's go look at some other time frames and see the differences, right? So, for example, we're going to go on NASDAQ on the 3 minute, and we're going to go to S&P on the 5, okay? And we're going to go back to the highlighted section of the New York Open, okay? And I don't need this to be highlighted anymore. So, obviously, you're going to see less candles because there's less 5-minute candles in a specific time frame because it's obviously divided differently. The price flow is going to be the same, okay? Now, the different charts, it's going to be different. But if you have a 5-minute on NASDAQ, it's going to be the same. Like, in this hour on the 3 minute, obviously in NASDAQ, if we're down 1.17%, it's going to be the same thing on the 5, right? We're going to be down 1.17% in that time period. That's a very simple thing, okay? Next up, if we are on the 3 minute, and let's, for example, say this, right? We have, okay, let's look for a possible entry and see if one of these two can give us the possible entry. So there is this on the 3 minute, 2, this on the 5 minute. Now, this fair value gap is touched around the same time the 5-minute fair value gap is touched. So the 5-minute fair value gap is stronger and more useful, so fuck the 3 minute. But during the time we are currently waiting for price after making this to come back up into it, right? In between, look guys, in between this area, we don't really have anything. Oh, I'm a blind motherfucker. We do have a 5-minute fair value gap again. Okay, now let's say we didn't have this 5-minute fair value gap. Let's say there was literally nothing right here, okay? And we had all of this space to just wait until price came to this 5-minute point, okay? In hopes of going down or up. But the 3 minute right there gives us a fair value gap, and then price reacts off it before, we even touch this. The 3 minute is higher time frame than the 1 minute, and it's showing us stronger flow. Now, let's say we have a super strong or good reason to go short this day. We don't need the highest time frame. We don't necessarily need the 5 minute. This is strong enough for us on the 3 minute. So what we're going to do is look for an entry on an earlier time frame. We come down, create the fair value gap, come up, close above, inside. Obviously, we close bullish inside. Then we close bearish underneath. Now, this is not to say you should have placed that fucking trade, obviously. Not just because we lost, but it's because, bro, that wasn't enough confluence, okay? Maybe you could have freaking waited for some 30-minute or 1-minute entry, okay? And we'll talk about this in later videos. You don't have to completely understand how to use these in a trade yet, guys. You're not trading. You're just learning these basic things. So with that being said, you understand how you can use these lower time frames for quicker entries, and also possibly getting an entry on a day where you wouldn't have if you hadn't used a lower time frame. So I hope that makes sense. One sec, I gotta piss. Alright, I'm back. Yeah, so for the last example, I'm gonna show you guys what I would usually do in a trade. So let's say I'm looking at NASDAQ, okay? And let's just say for both charts, I'm on the 5 minute looking for an entry. And let's say I want to go short. And then on both charts, and I'm just showing you guys on S&P so we can see it clearly back to back for a good example. Let's say I'm looking for shorts and we have some possible bearish structure on the 5 minute. And then on the 1 hour, and this, again, like I just said, NASDAQ on the 1 hour, okay? Let's just move the chart, right? Let's just switch the damn chart. Why not? Let's say 1 hour NASDAQ, then, when did we close? Let's say this. Let's say this, actually. Or, oh, no, better example. Right? Yeah, so here we have, let's just say, hypothetically, we want to go long. And on NASDAQ, we have 5 minute, reason to go long. Right? So let's just say we've swept out these lows, okay? Come up, we inverse this bearish 5 minute fair value gap, and right around this area after we close, I'm looking for entries on the 1 minute. Like, very simple, right? I'm just looking for entries on the 1 minute. Okay? So now I'm on the 1 minute looking for entries, right? And again, we will get into placing trades in the future, but this is how it works. Let's say I want the break-even area to be before we go. So I have like a break-even area of right, here. The beginning of this 5 minute fair value gap. And like I just said, I'm on the 1 minute looking for entries. Okay, I see like this perfect chance, possibly, right? It's like really good opportunity. So, and this is when it closed. Okay, let's be very exact here. And how far of a freaking 60%? Gosh damn, bruh. Fuck the BPR, don't care. Literally do not care. Yeah, let's basically say I'm looking for entries right after this now. I want a retracement into, this. Let's say I want a retracement into this fair value gap, and then just a break of structure after we get out of it, okay? Right here we have a retrace, and we basically have a fucking entry, right? Okay, and I put my stops below here, and I'm just about to place the trade, but just to make sure everything's right, I go to the 15. Okay, and then I see, oh shit, what is this? Why? Right here, right? Like right in the trade area, hypothetically. Let's say it's closer up in this area. I'm like, oh shit. On the 15 minute, we really broke structure to the downside, and I'm looking for an upside trade. I'm looking to go up. Now, what you wouldn't do, and this is why this 15 minutes important, or a higher time frame that's closer down to the 1, 5, or 4. So not necessarily a 1 hour, but in this case, the best case scenario, a 10 or a 5. Let's say on the 15, we close the opposite direction down. This is a powerful candle, right? It's more powerful than the 5, obviously less powerful than the 1 or the 1 hour, but it's powerful, okay? It has enough power to fuck my whole trade up, which clearly it moved the market down instead of up, okay? This would have been a good trade other than when this happened. what I'm going to do is, since we closed at 9:30 to the downside, I am going to wait for price to prove that it's not moving down. So what I'm going to do is, since we closed right here, right? We closed just right there on this candle. Come on. I'm going to look for an inverse to the upside. I'd prefer to just like pass all of this level and break structure, because the reality is this is sketchy and bad things could very well happen. At the end of the day, I'd probably, if we did get a trade, it'd probably be more up here. I'd have my stops at the point that clearly isn't. And if we got a break of structure, even if it was just an old break of structure, right? Not new points, just an old point break of structure, then I would place my trade. But in this scenario, we're not going what? We're not going long anymore. We are making sure that if we are going long, we have a reason to, that proves this 15-minute break of structure to the opposite side is not going to fuck up everything. And that is a simple form of how I use time frames and how we will be using time frames. Okay? I'm not going to bore you with things you couldn't really understand. I'm not going to make this too complicated. And that's why I'm going to end it here. Your homework is going to be, how do I do this without making it really, really sketch? You guys are going to have your two charts. You're going to pick a chart, okay? NASDAQ or S&P, okay? NASDAQ or S&P. Now, put one chart on both sides, okay? And I want you guys to go to the lower time frames, so a 3-minute, 2-minute, or 1-minute. And then on the other chart, I want you to go to a 5-minute, 15, and a 10. So one of the 5, 6, 7, 10, or 15s. And I want you guys to kind of go into a New York session open area. So one of those green areas, the most volatile sessions. And I want you guys to kind of just look at, what's going on. Like if we break structure to the downside or upside on a candle, what really happens at the exact point on the lower time frame? If things look bullish in your eyes on the 1-minute, okay, but the 15's going down, try to figure this out. Maybe we inverse to fair value gap, hypothetically, or maybe we, like in this area, broke structure to the downside, or maybe we had a really big hammer candle, but not towards the upside, to the downside. Maybe something like that happened. Try to figure that out and do that 3 times. This homework is a bit harder, but it's important because we are getting to more complicated stages of trading. And if you guys can do this and show yourself that you can do this, you're just going to get better and then eventually become profitable, okay? With that being said, I will see you guys in the next video. Deuces.